Hello, and welcome to myfinanceteacher.org. In this video, I want to talk about the general stock market as well as crude oil market. Before we continue, let me remind you guys to subscribe to the channel if you haven't and click that bell notification. Thanks a lot. As you see here, I posted a few days ago that I was entering S&P 500, SPY more specifically. My entry was somewhere at about 249, and since then, unfortunately, I was stopped out at about 238. This is normal as long as you understand the risks that you are taking. You have to keep your losses to a manageable level, and at one of these nice bounces, once you consider other indicators as well that might indicate a change in the trend, with one of these bounces with a good risk-reward ratio, you might actually get a return that would cover all of the previously managed relatively low losses. So let's have a look at S&P 500. We don't see a setup at the moment. However, in general, I think an intermediate cycle low is probably 1 or 2 weeks away. What I want to do here is have a look at some indicators that lead me to this conclusion. First of all, as we see here over the last couple of weeks, although we've seen lower lows on the price range, RSI hasn't been confirming. We have a positive divergence on RSI over the last couple of weeks. Secondly, we are extremely stretched to the downside from this 200-day moving average. The stretch is 33%. So as I said, although we might continue down for another few days, we'll probably see the low in the next couple of weeks. Talking about other indicators, we've been poking through this lower range of the Bollinger Bands multiple times. The price is currently back within that Bollinger Band, so there is a small chance that we will not see any pokes through the lower range of the Bollinger Bands, and we might see the start of an advancing phase of a new intermediate cycle relatively soon. Next, I want to look at the put-call ratio. We see that we've recently seen a relatively historic high in put-call ratios, which means the general public is extremely scared, and as you know, the time to buy is when greed is at the lowest among the general public and fear is at the highest. The time to buy is when blood is flowing on the streets. This relatively high put-to-call ratio has also been observed here in late 2018, where put-to-call ratio was above 1.1. In late 2018, as you remember, there was also a relatively scary drop in S&P 500. That drop was about 15% below 200-day moving average. Compare the put-to-call ratio we've seen several days ago, which was very close to 1.3, to what we saw in late 2015, early 2016. We see here again put-to-call ratio slightly above 1.2, and that's when we saw another relatively scary drop in S&P 500, which went about 12% below the 200-day moving average. And lastly, comparing the recent put-to-call ratio of nearly 1.3, we've actually come quite close to what we saw during the global financial crisis in 2008, when the put-to-call ratio was somewhere at about 1.35. So my point is, we are at extreme levels at the moment, which tells me the chances are high we're approaching the low and approaching a nice buying opportunity relatively soon. You might say, well, now the times are different. We have a global pandemic that is killing everyone. And you are right, the economy might stay in the toilet for an extended period of time, another several months, for example, but it doesn't mean that the markets can actually jump out of this oversold condition. Remember, markets are forward-looking, and the bad economy over the coming few months should already be priced in. Looking at this chart of coronavirus cases, we see that today the increase in the cases is relatively insignificant. One day, of course, doesn't tell you much, but there might be a chance of a slowdown of new cases appearing, with people taking it more seriously and actually implementing some kind of social isolation. And to repeat, even though the effects of the coronavirus on the economy in general, on unemployment, will continue to be negative over the next several months at least, if we see even the beginning of reduction in new cases, that might actually be very, very positive for the stock markets. And additionally, As we mentioned previously, central banks are printing trillions of dollars and cutting interest rates all the way down to zero. And it looks like more relief might be on the way from the president and the Congress. And an interesting point here is that this relief might be quite substantial as well. Another $2 trillion to support the economy. And lastly, on the technicals, looking at the duration of the ongoing intermediate cycle, if we don't break the recent low that we saw on the 18th of March, that would give us 289 days of this intermediate cycle, which is a rather stretched one, since usually these cycles last for about a half a year, although they can easily stretch for quite longer than that. So personally, I'm not in the markets at the moment, but I will try again when I see a setup with an attractive risk-reward ratio. And next, moving on to crude oil, another painful market, where we also see multiple pokes through the lower range of the Bollinger Bands. The price is again within the Bollinger Bands, and the relative strength index is deeply into oversold territory. However, technicals of course might not really mean much if the actual oil price war between Saudi Arabia and Russia continues to intensify. Nevertheless, I think we are close to an intermediate cycle low over here, although of course there are no guarantees and I might turn out to be painfully wrong. Again, if we don't break the recent low from the 18th of March, that will give us an intermediate cycle going on for 167 days. That is if the correct count for the ongoing cycle is from early October last year. In this case, we're approaching a regular time range for an intermediate cycle low, which usually lasts for about half a year. Alternatively, if the correct way to count the ongoing intermediate cycle all the way here since early June, that would give us a cycle that has been going on for 287 days, which would be quite a stretched one, giving me an expectation of some sort of a bounce coming up soon into the next intermediate cycle. Since the price of crude oil has been range-bound between this $50 to about $65 for nearly a year and a half, it makes it a little bit difficult to identify the correct way to count these intermediate cycles in crude oil. Whichever way you count them, cycles are generally based on the market sentiment. When the sentiment is extremely pessimistic, that's when everybody has sold out of whatever asset you're looking at, and that's when we see an intermediate cycle low. When the sentiments are extremely optimistic, that's when everybody who wanted to buy has already bought, which means there might not be much more inflow of capital into whatever asset you're looking at, and that's when we would see an intermediate cycle top. That's the theoretical basis for this cycle theory. And moving on, I want to have a look at a couple of interesting crude oil charts. Here the black line is the price of crude oil, the orange line is its 20-week moving average, and the green line is showing how much crude oil is either above or below its 20-week moving average. And we see that at the moment we're over 50% below the 20-week moving average, which is a historical extreme, at least for this chart, going back to the beginning of 2006. And the last time that crude oil was over 50% below its 20-week moving average was here again during the global financial crisis in 2008. And that corresponds to a significant low and a very nice buying opportunity on the price shown by the black line. So although there might be some pain in the short term on crude oil as the price war continues, in the long term, I think we're going to get a very nice buying opportunity sometime soon. And the last chart I want to show you for crude oil is a chart where the green line is the number of standard deviations that the crude oil price is away again from its 20-week moving average. Currently, we see that we're nearly 3 standard deviations under the 20-week moving average. Generally, whenever we break this 2 standard deviation line over here, it often is a good buying opportunity. However, it's not always a good buying opportunity. We've broken this line on this chart several times. Here in late 2006, early 2007, that was a very nice buying opportunity. This happened again in 2008, which was again a very nice buying opportunity in crude oil. Here in the middle of 2012, that was a modestly good buying opportunity. In 2013, there was only a small increase in oil price. And over here, all through 2014, although we see this green line dipping below -2, the crude oil price continued to drop all the way into late 2014, early 2015. Again, in the middle of 2015, there was not a nice buying opportunity. Next, in late 2015, there was a modestly good buying opportunity. In early to mid 2017, there was again a nice buying opportunity and a modestly good buying opportunity over here in late 2018, early 2019. So over the last 15 years or so, out of 10 times, we've seen this indicator dip below -2. In 65 to 70% of the chances that was a good buying opportunity in a relatively longer term. So talking about personal positions, I'm hugely in the red on energy, unfortunately. That's partly because I hold some shares of companies that used to and hopefully will continue to pay a nice dividend, and I have been holding those shares for a number of years already in the part of my portfolio which I consider to be my dividend related part. So I wasn't planning to trade those shares. Unfortunately, I'm also hugely down on the traded part of energy portfolio, where I'm about 50 to 60% into USO with an average price of around 7.5. And I'm actually thinking about converting that part of the portfolio into some energy companies instead of holding USO, which is actually deteriorating over time. Luckily, I still have 40 to 50% cash in that part of the portfolio. And as I mentioned, I think in the long term, crude oil price is forming a relatively significant low at the moment. So that's my opinion on the stock markets and crude oil. Let me know what you guys think of these painful times. Most importantly, stay healthy and good luck in your trades.